Yo, back with what is amazingly episode 100 of Drop the Journey. And I feel like I should have done some like dramatic fucking compilation video or something. And maybe I'll do that and post this later, or I don't know, whatever, hire some fancy editor for that. But the last video I posted was probably like the most, I guess in my opinion, like the most uniquely insightful video, just in the sense that I don't think it's a topic many people, if any, to be honest, speak about on YouTube. Certainly not like ones that are currently going through it in building consumer brands, etc. And I had more comments and DMs off the back of that than usual, like more deep ones. So yeah, I just thought I would answer some of those questions basically in like a high level format. I'll try and make it slightly quicker. Don't expect me to go deep into every question. I've basically like ChatGPT summaried all the questions combined with like some ones on DMs, etc., to try and do it over like a few sections. And I will also be using the iPad again, which I've figured out how to actually fucking record on now. Don't know how much I actually need to show on here this time, but I'll track it just in case. And yeah, like I said, high level overview on some of the questions. And then maybe afterwards, if anyone's got any more questions, drop them down below again, drop me a DM, whatever. Or book a call with me if you want to go through like in insane detail on your own shit. Because I'm doing a bit of that now and then, just on like weekends and shit, because I just fucking enjoy talking about this shit, to be honest. And yeah, I'll probably go through in more depth some of these topics. I don't know where to draw the line on this, because I feel like I'm very transparent, and I've been more transparent in an area that's probably something I've been less transparent on in the past, but I don't think I've crossed a line there at all. Ultimately, a lot of the stuff's in the public domain anyway. So yeah, first section. I don't know if I need to draw this, but I kind of enjoyed drawing it. Section 1. Everyone's going to realise that I'm like borderline dyslexic when it comes to fucking writing stuff. Pre-rev, fundraising, fundamentals. Can't even fit that on there. First question: how important is a financial model? When should you build it? How does it help? Etc. etc. I want to whiz over this semi-briefly. Yeah, basically I think a financial model is, basic terms, is a fucking budget, right? It's a plan, a spreadsheet, a very fancy in-depth spreadsheet of what you're planning to do, i.e. like next year or in the current year, but like genuinely you plan it at the end of the year for the next year. So like when I raised money, did we have a financial model before? Yeah, to be fair, we actually did. It's basically just a budget. A lot of people say you can scale without a budget and stuff, and to some extent you can. But I think when you get bigger anyway, you're obviously going to have some sort of budget, mainly for like stock, cash planning, etc., etc. Give yourself targets, because then you don't know what's good if you haven't got a target, right? I've heard arguments saying like, why do you need a model and stuff? Why do you even need targets? Just fucking scale. And there is merit to that mindset, and I agree in some ways. But when you raise money, especially less so from an angel investor, but more so later on when you've got revenue and you want to show what you've done, so like management accounts, etc., then the model is really a part of what you will be able to raise money on, and it's effectively a financial illustration of the business plan next year, right? Or the coming few years. So how do you build it? I mean, ultimately, I can't do it myself. Unless you're a finance professional, you probably can't do it yourself. We have a fractional FD who I'm not going to say their name off because I want to fucking gatekeep. I've referred him to a few people. I think he's pretty full anyway, but I'll just go and get a fractional FD. I mean, again, like fucking Google, LinkedIn, probably cost you a few grand to get a good one, at least. I mean, in terms of doing the initial model, I think I paid 10 grand for the first model in one lump sum, and then we used this guy ongoing after that. But yeah, how important is it? I think you need some sort of one, certainly to raise money from any bigger ticket investor. So basically anyone other than an angel, so family office upwards, referring to the last video. I think it's also just good discipline, good management, and good skill set to build in terms of how to understand a proper financial model / budget. It's kind of the same thing. And also learn how to, dive in and look at stuff, right? Because we're currently looking at our 2026, because our financial year is the calendar year, like a lot of e-com brands. I think there's benefit in that. 26 planning, and I've, drafted a model which in some ways is like finger in the air stuff, and it kind of is more that when you're newer because you don't have as much data to go off. But yeah, like I said, not going too deep on everything, but I think that's an important one to have. I'd recommend getting a basic version. I mean, like ChatGPT could probably help to some extent these days in terms of finding who could do it, or even just YouTube. But yeah, I wouldn't do it yourself unless you're proper like trained accountant or financial modeler, whatever, which I'm certainly not, but I do understand how to read one in depth now and how to use one. So that's the first question. I'm not really drawing here. Second question, how do you pitch pre-revenue, must-have elements, team story, problem, momentum? I think this is actually a more interesting question, which gives me an excuse to fucking draw on the iPad again. I think, and again, I caveat this video, like all the others, but especially this one, this is my experience. It's a combination of my knowledge, my specific experience in terms of what I've done, what happened to me, what worked for me, what didn't work for me, but also, probably more importantly, the curated knowledge and perspectives of much smarter and wealthier and more successful founders and operators than me, i.e. investors I have, investors I've met, other founders I've met through my investors that have actually gone on and built 9-figure businesses and exited them for 9 figures, importantly. People on my board who have seen and done this before. So yeah, everything in this video is a collective blend of that, and it's not just me talking shit or without any context, and it's not just my own context, it's more experience stacked on top of that. So yeah, that said, how do you pitch pre-revenue? I haven't rehearsed any of this, haven't planned any of this. I'm speaking completely off the top of my head, which might make me sound stupid or say the wrong thing at times, but it's kind of how I work and how I think, and it's how I would pitch anyway, generally. It's not very scripted. How do you pitch pre-revenue? This might be a duplicate question later. I mean, ultimately, I think there's 4 things when it comes to pitching in general, and then we'll get to pre-revenue. I think one is founder. We'll come back to that. I think it's arguably the most important one. Secondly is category / opportunity. Like, what is the fucking business? Does it make any sense? Or more like, what vehicle are you in? It's probably a better way to put that one. The next one, I say, is kind of vision and story, which is kind of a combination of these things. And then the last one I would say is numbers / finance model, i.e. what numbers have you actually delivered? So, proving that your concept works financially to unit economic extent. And what do you plan to deliver soon? But obviously pre-revenue, this one is not relevant. Pre-revenue, it's really these 3 things, right? And they're all easier if you've built stuff before. Not necessarily raised money before, but let's assume you haven't built stuff before. Or actually, let's ignore that, but just remember that caveat. It's all easier if you've built stuff before. I think the most practical and tangible one is this, right? So the category and opportunity. Functional beverage, for example, which is what I'm in, I guess has been quite a popular category because it's had a lot of headwinds in America. There's been major deals that have happened in the category, especially in America, which tends to happen first. An extreme example of one that might be less popular with investors and just have generally less tailwinds, I'm trying to think of a good example without saying the wrong thing, might be, I don't know, fucking teeth whitening. It's kind of happened 10 years ago, right? With High Smile, other brands. Don't quote me on that because I'm sure there are teeth whitening brands successfully raising, but to illustrate the point. So yeah, there's that. What are you doing? That's the vehicle you're in. Ultimately, you've chosen that at this point. I think there's the founder, and I would argue in some ways this is the most important one in some ways. I don't know why I put an X there. And this is a combination of your ability to explain why you're in this, sell the vision and story of why someone should invest, and ultimately why they're going to get a return. Because aside all the fanfare, ultimately people want to put easy numbers, 100 grand in, £2 million out. That'd be a really nice outcome, right? Simple terms, a lot of nuance to that, but yeah, easy example. And the founder is really the combination of all these things. And I think it's a lot easier to raise if you primarily have done stuff before, even if it wasn't necessarily venture backed, even if it wasn't that successful, but you've proven that you have the fundamentals. For me, I'd built dropshipping business before. I built a jewelry business to about 4 million in revenue, profitable, no investors, which I sold for a bit of money, as I mentioned, not as much as I'd like because of the context. And then I'd also actually, in some ways for me, this was a great part of the story, I'd had a brand that had grown and crashed and burned, and I'd lost a lot of money, got into really poor mental health, and actually that became part of the story here, which was the legitimate story, but also the slightly refined version of I got into functional ingredient obsession because I was drinking them, right? I was using them. So basically all these things combined, hot get category, chip on shoulder founder, at least in my case, with some experience, so proof that I can actually build stuff. I think built a good story, and my vision was, I guess, ultimately quite well displayed. So I think you need all these things, these top 3 things to some degree. Obviously, if it's your first rodeo, I think it's going to be harder, but I think you can still raise, most likely from angels, most likely at a lower valuation, most likely less cash. But yeah, fundamentally, I would say that will come back a bit more to pitch decks and stuff later on. I just realized you can't see my screen with the questions on, but maybe I'll add them in after. So the next question is going to let me scroll. How does this work? Yeah, cool. This is already going to be a way longer video than I had prepared in my head, as it always is. Right, cool, continuing. I'm going to skip some of these questions. Someone asked, third question, how detailed do financials need to be for pre-revenue? I think the quick answer to that is not that detailed. I think it would come back more to these things. As I said, you probably wouldn't have much of this until you're post-revenue or dealing with bigger money, which you would have to be post-revenue to be doing. So that's that one. Question 4, what do VCs want to see in that first meeting? I mean, I'm not a VC. I'm just speaking from my experience. I think ultimately, again, cop out, but it's true. They want to see a combination of all these things. I think they want to see, I think firstly, if they're speaking to you, it's a category they're somewhat potentially interested in, because most investors at a VC scale will have a general thesis and a niche to some extent. There are like sector agnostic, more general investors out there. There's quite a lot of them. But generally, they still have areas that they're more focused on. So I assume if they're speaking to you, they've agreed a meeting, either they've come to you or you've gone to them. For me, initially they came to me, but then I also did some outreach. They're interested in the category. I think they want to see, firstly, excitement about the category, why what you're doing is interesting, why you are uniquely positioned to deliver it. Like for me, it was the story around I'd done it before. I'd fell in love with the category from a personal perspective, and then I felt like I had a problem to solve and that nothing tasted nice, and nothing was all in one, no one was doing it in the UK, etc. And then a bit around the vision and story. Ultimately, especially VCs, they don't want to hear you say you're trying to build a £3 million a year lifestyle business. Like if that's true, just don't raise venture money, basically. So yeah, that's that one. I don't want to spend too long on it. Section 2, coming down, pitch decks and storytelling. I feel like this is an area I'm probably rusty on, and I'll do a longer video potentially. And I might even show like the original fucking pitch deck I did back in September 2023, which is ultimately what got a deal done in the first place with a venture investor. High level, what to include in the pitch deck. I mean, it's basically what I've just spoken about. Like, without going into my exact pitch deck, I said the most important parts are, and I'm going to pretend these are slides, maybe like 4 slides. I'd say your deck wants to be pretty short, but I would say vision, like in a sentence, what are you trying to do with the business? Like for me, it was, I want to build the category defining functional beverage brand, which, or maybe it wasn't that. That was a part of it. I probably had like vision, mission, strategy, but you get the idea. Like in a page, what you're trying to do. And then I think there's specifics around category and opportunity. Like, you know, is the category growing? Is there a massive gap that you see? For me, it was stuff that tastes great, is simplified, and is in a growing category that combines ingredients. And I felt like everyone in the category was super boring, etc. Vision, category. I think, especially at early stage, I think you've got to do a bit about the founder, like what's your background, why you, etc. I mean, I'm basically repeating myself from the above, but that's because it's all relevant stuff. And then I think ultimately there does need to be some unit economics. Even if you haven't launched, you need to fucking understand this. And financials, even projections. The reality is most people fucking inflate their numbers in pitch decks. I mean, I've been sent many, and like people saying that their CAC's going to come down when they quadruple spend every month or something. But yeah, so I think having credible idea of your numbers, and it's pretty obvious to any decent investor if you're talking out your ass or not, basically. So yeah, that's what to actually include. I think the next question was question number 6. How to tell a compelling problem solution story. I think, again, I kind of repeat myself. I think from my perspective, it starts with you being the customer first. And why did you get into this? For me, I was literally, I'm not exaggerating this. I was unscrewing capsules, because I can't swallow tablets, and pouring them into a drink. And then I thought, oh, these are quite interesting ingredients. You know, too much anxiety from coffee, but it tastes like shit. But I don't want to stack different things like a lot of brands are offering. Added it to chocolate powder, and that was like the first thing. And then I looked at like the story around, I'd seen what happened in America, blah, blah, blah. I wanted to make it pink to stand out because I'm into pink, like even just a nod to my previous businesses, stuff like that. I mean, I can't advise on how to tell the story, but I think if you're going to be a successful founder in any way, you probably need to be quite good at that in general, not even just for fundraising, for inspiring the team, speaking to retailers, whatever it is. How I built my early decks, I mean, again, I want to zoom along a bit more here. I used a website called pitch.com. In fact, I didn't. I used to use fucking Google Slides and realized it was terrible. Use pitch.com, that's what I currently use. I think it's like £5 a month, or even a free plan. It's just a good solution. So that's what I use. I actually genuinely think I'm pretty shit at making decks. I think a lot of bigger brands for bigger rounds, and I might do it in the future if we ever raise again or whatever, I'd probably hire a professional deck designer, to be honest, because I literally did it myself, and there is an art to it, both in the content, the structure, the order of it, but also how it looks. And I think mine were okay at best, and maybe I'll show them there. The pitch process, before, during, and after. I mean, for me, I never prepared for anything. I think my style, as you can probably tell by watching the YouTube, I say I don't prepare for anything. I don't consciously prepare for a specific thing because I feel like I know the topic inside out. I mean, you should if it's your own business. So I would just go into pitches. I mean, probably bad, but I would even drop an F-bomb because that's how I speak. And it was kind of like, I didn't dress up for any of this shit. I'd rock onto it was mostly in calls. I did have a few in-person ones initially, but mostly calls to start with. I'd rock up, black t-shirt, cap on, whatever, shit haircut like now, and just tell the story. And I think if you're authentic and you actually know what you're talking about and you are genuinely passionate and interested in what you're talking about, that comes through. I think it's bad to try and be too prepared and too corporate and too robotic. Maybe there's a market for that, but that didn't work for me. So yeah, do that. I guess during, high level, you have a fucking call. You probably have a second call. This is, thinking out loud. Maybe even have a third call. Maybe this is with someone more junior in the team. This is with someone more senior. Maybe this is with the most senior. And to be fair, by this point, you've probably sent some data. Assuming you're speaking to VCs, you should already have numbers and sales. And then maybe there's a meeting in person. Maybe there's more data, speak to team, other investors, angels if you got them. Maybe there's another call. Then maybe there's a term sheet, which is an offer effectively. And then following that, there'd be a very long and painful due diligence, which I mentioned mine was 6 weeks. And then, legal docs. And then the final stage, cash and close. So that's a very brief rundown. But yeah, hopefully that makes sense. I'm already 20 minutes in and I'm wasting too much time on each question. So how team structure and dynamics evolves at different stages. If I can't write. Again, this is just for me, so do not take this as gospel, but people are asking, so I'm telling them. I think fundamentally, certainly for me, pre-venture raising, I just by default thought about doing as much as I could, me, and very lean basics, right? So we had a few agencies, didn't have any employees. I had a few freelancers. So I think the team was 3 people when we first raised. It's fucking small. And then I think the biggest change since raising venture, and it comes down to ultimately the economics of raising venture money, is that you basically have to go big, or as big as is economically viable. Obviously while remaining efficient, et cetera, et cetera. I'm not saying as big as possible at all cost. I'm just saying you have to think about going bigger. And I think the mindset moved to, maybe this is obvious, but it wasn't to me. It moved to more hiring for where we want to be rather than hiring to fulfill what we're currently doing. So basically investing in future capability ahead of time. And often that can look like heavy OPEX, at least relative to where you have been as a percentage of revenue. Again, I'm not going to say too many numbers because I don't want to fucking shoot myself in the foot by sharing everything on the internet, but maybe my OPEX was, 3 to 5% pre-raise. And then after raise, it was probably triple that. Not immediately, but, over the next 6 months to a year. And this bit took me about a year after raising to actually even properly do. We raised in December 23. honestly, I didn't have a real team, like not all areas, but like I didn't have the fully fledged team I have now until about a year later. So about 8 months ago, like December 24 was when we really fleshed out the team. I spent way too long, even after raising, because I'd not done it before, just thinking, I'm just like, we'll just keep the money in the bank and we'll just keep running as lean as we were before. But then I realized that had big bottlenecks, and we hired a head of growth was the first. That's not true. Brought customer service in-house as the first employee. Then we hired a social media manager in-house. Head of growth was my first, I guess, more senior hire that was like taking off a big thing from my plate that I was spending, not off entirely, but obviously initially like working with me, and now runs the whole growth team and is doing a very good job. So yeah, I guess that was the fundamental thing. My default being, and this is me plus the situation, I'm not saying this is how all founders think, this is my experience. It was me plus whatever I needed to survive, and then it became more, how do we get to 50 million plus, basically? And people, I think, naively think they can just do that with one person, and maybe you can for a month, but it's not very sustainable. So the mindset became, how can we build the capability and actually hire a bit ahead of growth and then grow into it so we're prepared. And yeah, there's pros and cons to that, but that was basically how we did it. Bootstrap versus venture-backed teams was question 10, but again, I've kind of covered that in this section. Q11, what to keep in-house versus outsource. Yeah, this is like a really interesting age-old debate. I'll tell you what we did and what we currently do. And again, there's no right or wrong. Maybe some of what we're doing makes sense. I guess the one thing I haven't brought in-house is media buying. We still have an ads agency. I think that's probably one of the few things I would maybe potentially always not bring in-house, because I personally think there's benefit in agencies seeing other accounts, etc. I pretty much brought in-house everything else in terms of core function, but then we still use agencies and freelancers for like an extension of the executional capabilities. So probably sound like I know what I'm talking about, and I probably don't, to be honest, but think of like the core team, this is employees and like the odd freelancer that we consider like the core team is, I think, like, I'm going to get this wrong, I think it's 13 people now, roughly, maybe 15, I could be wrong. If you include like all customer service reps, probably 15. And then we have agencies, which basically work under key members of this. So like we've got a media buying agency, a creative agency that works under my creative strategists, etc. But we have the core things in-house. We also have a retail agency, for example, currently, which may or may not change. But again, they're reporting to someone in the internal team. So someone said it's like a spoken wheel thing. I don't know what the fuck that means, like some LinkedIn exaggerated term. But yeah, that's how I think about it a little bit. I guess that's how we're currently doing it. And then there's the odd, smaller scale freelancer, which again, just adds into this. So I'd say that like in terms of cost, a bit different. In terms of headcount equivalent, it's probably like 70% employees now, the rest being freelance and agency. And I think that works quite well. Cost-wise, it's probably more like 60-40, even 50-50, because obviously certain agencies there's more than one person, so they cost more. Like, so headcount-wise, I'm calling them one, but cost-wise, it's more. So yeah, I don't want to spend too long on that, but that's like a high-level thing. I suppose the closing point on that might be, I think it may be encouraged to hire in-house, but it's not for the sake of it. I guess it's through the lens of it helps us build a bigger business and future-proof, and ultimately you want to have people that help you drive the business rather than like agencies that could leave tomorrow and don't really give a shit. So yeah, that's how I think about that and how I have thought about that. Reporting and accountability after raising, fuck me, it's kind of a boring question, but I ran over this before. I keep it brief. High level model, you agree at the start of the year. Monthly finance call, which we'd have anyway, by the way, but just with certain investors on, basically reporting to the board on performance. Are we beating the budget? Up, down, where are we? Standard shit. And then I guess maybe a slightly bigger one, quarterly board meetings, which might sound all fancy or whatever, but I guess it kind of felt to me a bit fancy at the start, but basically it's just 3 hours in a room, even 4 hours sometimes, physically in a room with the investors and key members of the team. Again, stuff you would be kind of doing internally anyway, just reporting on what's going on, strategy, more high level strategy stuff, run through the quarters numbers, etc. Again, going back to this model, because this is what you've agreed to deliver, basically. And it's not always going to be perfect, but like last year we smashed the model. This year, smashing it slightly less, but we're still doing well. But I think the model was potentially like too ambitious in many ways. And we just like decided that it would be better to pull back a bit in certain areas to be more efficient. But yeah, that's basically it. I think one thing that might surprise a lot of founders, but I think a lot of founders might have to adjust to it is, I think a lot of founders of smaller businesses just sort of, how do I put this, are slightly lighter on their like legitimacy if certain things they're doing, like in terms of putting like personal costs through the business, etc., etc. I suppose that one thing that's changed for me, and we'll get to it later, is I don't do any of that anymore. I used to like build a big director's loan, etc. Now I just take a salary, like a decently big one, and that's it, right? Because one thing you'll agree to, and it's never happened, but you could be audited any time, right? And you don't want to be fucking found that, like I've heard horror stories crazily, like through the grapevine of founders like raising millions and then spending hundreds of thousands on like fucking partying and shit. It's kind of crazy because you could technically do that. Obviously you'd get in deep shit for it, and I've never done that and I never would. But yeah, I suppose you have to remember like it's not your money. It is the business's money and you own most of the business still. But like I think there's a responsibility and a maturity that comes with ultimately like looking after money that has been invested in the business and thinking about starting to properly consider your legal obligations as a director of a business that you're not the only shareholder in. So yeah, and that sort of stuff that, again, might seem pretty obvious, but I think a lot of people would find that a bit of a change. And I guess ultimately this reporting stuff is a big part of that. And I think I mentioned it in the previous video. I think it's a good way to learn about proper larger business governance. And I completely think a lot of corporate stuff, I'm not saying this is that, but generally a lot of corporate culture, I think a lot of founders would hate. I'm not saying it's that, but it's learning how to manage a business and a larger team with obligations and ultimately shareholder interests that aren't just yours, even though yours will be inevitably the vast majority in terms of equity and, emotional and mental state in the business, because obviously funds are invested in multiple brands. So while they care about the business, I would hope that the founder cares most, and I certainly think I do. So next section, bit of a personal question, this one, but I'm happy to answer it. From my perspective, again, I think everyone's different. The question was, how do you fund your lifestyle? And you referred to like, not like bougie lifestyle, but just like fucking living when bootstrapping initially, like low salary, you're not taking anything out, and now. I'll give you my perspective and then I'll maybe give another perspective. So I'll just tell you what I did. Basically, I didn't take a penny out of this business for the first 2 years, and that's not an exaggeration. That's pretty painful when you're working on something and not taking money out. But I had savings, and I had my YouTube. I had an ecom course, which did like pretty well. Like I was fine, put it that way. And I guess now, so when we first raised, I started taking a salary, which was a decent amount. And then in the last year, that's gone up to what is, I guess, a more decent amount. I think in general, it's definitely not untrue that a lot of like startups, especially in the London scene, be careful with my choice of words here. Founders often come from privileged backgrounds financially. I do not. The second I was at uni, I had to get a job and pay for my shit. And even the proof in this is when my business failed, like the business went into administration. If I had a multi-millionaire parents, they probably would have bailed me out, but I don't. I think a lot of founders do, not a lot, but like the ones, there's a large amount of that you read about, especially in like the London food, bev, CPG scene. It's definitely a London thing, which, I think is frustrating for founders that don't come from that background, but I certainly don't. I think the truth of it is, this is why startups are hard. You ultimately want to be, cash flow positive ASAP when you're starting, and especially when you're bootstrapping, which I've done before. You need to make it profitable from day one. And if it's not profitable from day one, you need to be willing to fund the temporary cash flow negativity of that business, either through your own savings or raising money. Like that's just as simple as that. And even if you are profitable, especially if you're growing quick and you're at the start, you'll be reinvesting the vast majority of that cash into stock, etc. So even if you're making hundreds of thousands in profit or even millions, you might not actually be seeing much of that, if any. Although I'd hope at that point you were taking like some money out, right, in a salary, whatever, dividends, whatever's most efficient. So yeah, at the start it's fucking hard. I think this is why most people don't choose building a consumer brand, because building an agency is less cash flow heavy, as in it's less cash requirements to do that. It can be more cash flow positive immediately, if not always, because ultimately get a client that pay you. Same with that info and stuff. I think there are better ways to start a business that are less risky cash wise than starting a consumer brand, for sure. But if you want to build a brand that's really like in your blood, like it is for me, then you fucking figure it out. And it was like, even when you have some money and you're not like gonna die, having putting so much time into a business and not taking any money out of it is ultimately like the hard part of being a founder, right? And I think every founder, no matter how successful they are now, goes through a period like that, especially in building a consumer brand, whether they've bootstrapped it or raised money. I think you still go through that period right at the start. So yeah, it's fucking hard basically. And that's why a lot of people have jobs on the side when they start, or they raise some money, and even then they probably keep a job, or they, I think I've heard of founders, if founders have only raised like a few $100,000, you're probably not paying yourself more than 20 grand a year. And if you are, you're fucking stupid, and you should be keeping all the money in the business. I think it's only when the business is at sort of 10 million plus in revenue and has probably 7 figures in the bank that you're going to realistically be taking out like 6 figures a year. Obviously it depends, but like when you're on a growth journey, that's my rough opinion, and that's what I've heard pretty consistently with friends and other founders, etc. So anyway, someone asked a question. 40 was like the same as this. So, what is fuck you money? I mean, I don't know. I don't know if I mentioned that in the other video. I think having spoken to a lot of people much wealthier than me that have made a lot of money, and I know a few guys that have made in the sort of 20 to 50 million personally cash off table after tax range in their 30s. I could name 4 of them right now, which I won't name, but I know them personally, and like speak to them most weeks, etc. And I've asked them this question. Almost all of them say you don't need more than 10 million personally, and that's 10 million. I'm talking 10 million pounds net of tax, like liquidity, whether you put that in the S&P, startups, property, whatever, fixed income fund. Because if you're a decent non-idiot with your cash, at that point you're making minimum like 400k a year passively, hopefully a bit more. Yeah, you maybe need some liquidity if you want to buy properties, whatever, but either way you're making, okay, let's round it down, minimum 300k a year, even after you've bought properties, cars, watches, whatever. And that is enough for a fucking nice lifestyle. It's not enough to fly private, and it's not enough to fly private, have fucking yachts and stuff, but like base level, I think that is happiness. What does fuck you money mean? I mean, it's different to everyone. Ask ChatGPT this. I mean, even Andrew Tate and stuff have said this. He thinks more than like 20 to 30 million, it just becomes a game. So maybe it's that 10 to 30 million ballpark is what maybe a lot of founders would like to aim for. I've always had a number in mind, which I'm not going to say, but I do agree that 10 million is probably where I would stop worrying about money or be so paranoid about the next thing. I've made some money. I've not got 10 million personal liquidity yet, but do I see a path to that in the next few years? Yes, I absolutely genuinely do. I wouldn't be here otherwise. And I think actually far beyond that. But yeah, I think as a baseline, that's probably my opinion. I've spoken about it with a lot of people a lot wiser than me, and that's what they say. So, question 16. Well, this is going to be a long video yet again. How to know how much to raise, especially post-revenue. I think this is an interesting question. How do I answer this one without droning on for far too long? I think there's a few factors here. And it's a good question. In my case, like I touched on, I thought I raised far too much at the start. I was a bit panicked from previous business. People were kind of offering me money because maybe naively the valuation was so low and I didn't realize. I probably could have, I don't know, I'm not going to put a number on it, but I think I could have raised a quarter or half of what I did and it would have been fine. And in fact, it might have been better because it would have been more strict on where to spend money, and maybe we went too hard on marketing like the first few months, etc. We'll never know. It is what it is. Easy in hindsight, but I think yeah, I remember this guy asking the question. So how much to raise if you haven't raised and you've already got revenue? I think there's a few things. I think there is, again, coming back to the points of a model, what is the plan, right? Let's say completely hypothetically, you've got a £3 million a year business doing 10 to 20% EBITDA, hypothetically. You haven't raised, if you're going to raise any money, I'd probably say you want to be like bumping those numbers up next year, like minimum 6 to 10 million to make it a good growth story, like double, triple, whatever. So let's assume you want to go from 3 to 10 next year, which is similar to what we did. We did 3.5-ish, 3.6 I think it was in 23, just shy of 10 last year, so nearly 3x. And then hopefully double again this year. So the pace obviously slowed down. But anyway, so you want to go 3 to 10. You need a model, right? Because this is the thing. Like people have said this to me before. Even my own friend, he was like, "Oh, I need to like show a use of funds. Like, how do I do that?" And I was like, well, what fucking funds do you need? Like, because if your model doesn't need cash, and fundamentally your model will show, you put in your CAC, etc., etc. Maybe there's a separate video on this. A proper model will show you where there is a cash requirement, right? And you can either fill that through debt, which actually in many cases can be a smart choice, especially if you're highly profitable. But again, that comes with pros and cons, different video. Or you can plug it with equity, which is obviously money you don't pay back, but you give away part of the company, which is obviously more expensive, potentially long term, but cheaper in the short term in other ways. And pros and cons and nuance to both of those, which I won't go into. But either way, like a good model should show you whether there's a cash gap. And really you should only raise if there's a cash gap or there's a cash buffer requirement that would make you more comfortable in making the bets to deliver the plan, say 3 to 10 million, which might be, for example, launching in Europe, launching online in America, going into retail where we don't get paid for 90 days. Either way, the business generally needs cash at some point. But I think this is where you should start. Then how much to raise? I mean, ultimately you should start there, but like, let's just hypothetically say you land on £1 million. You want to raise £1 million. The other thing is just like, well, if it's a VC or even a family office or even an angel, anyone is going to want to have a certain stake. Let's just assume it's a VC because that's what I did. They typically want 15% or something like that. So if you're willing to give away 15% for $1 million, I'm not doing the math live on screen, but call it's a circa 6.5 million valuation, right? And then ultimately you've got to be able to prove either through your current metrics and or the model that 6.5 million valuation like stacks up and is valid. And that's usually a combination of your last 12 months revenue and your profits and your margins, etc. But probably more importantly, especially with the VC, what the growth story looks like. Because ultimately anyone investing wants to put in money at X valuation, get out a Y valuation, which is much bigger. It's as simple as that, really. Obviously easier said than done, but that is the basic version of investing, right? So yeah, you need to work out how much you want to raise. I'd probably raise it a bit more than you think you need. So you have a bit of a buffer, let's call it £1 million. Maybe you needed 700k, round it up to £1 million. And ultimately, the valuation will affect how much you can raise because you're not going to give away half the company, for example. Like if someone's only willing to invest at a 2 million valuation, which on 3 million revenue is unlikely if you've got a good growth story, but let's just say they are, you're not going to give away half the company. So like the economics of the equity have to make sense because any investor's also still going to want to make sure that the founder or the founders retain enough equity to be motivated, right? So that's a factor as well. And then ultimately the final point I'll say is like at a good price, depending on your growth vision, whatever, if you can raise a bit more than you planned in a good market at a good price of good valuations, it's not that dilutive, I would probably suggest doing it if you're going down the path of raising anyway. Because the process of raising, like even just the legal costs, especially with VCs, can be like 2% of the round. I think we spent 50 grand on legal fees on the 2.5 million raise, which is pretty ridiculous, but you got to get that stuff done right, and that's paying for you and the investor. But yeah, when you factor all that in, the time it takes for like a big raise, 1 million plus probably. Yeah, just something to consider. But again, just my opinion. Let's wrap this up for shortly. Minimum revenue and EBITDA needed for an exit. I mean, I feel like answering that just pretends I'm an expert. Again, I've synthesized a lot of information from much smarter people like me, like, managing directors at Houlihan Lokey, massive investment bank, Raymond James, Spain Lindsay, all these mid-market PE deal makers and PE funds, venture funds, etc. So I'll try and give my brief opinion from what I've learned from them. I think basically there's two factors to an exit. In fact, let me split this down and try and make myself sound smarter than I am. You have to think about, these are different things, right? A raise, assuming it's largely primary, which we spoke about, and an exit will command different multiples and different mechanics that get to that multiple, right? So a raise, you're ultimately, it's usually high level, just keeping it VC, and in my experience, you will raise on a multiple of your LTM revenue, so your last 12 months revenue. So not your run rate, which people like to pose on LinkedIn, which makes it look bigger than you are. Your LTM is your actual net revenue of the last 12 months. That's typically the baseline number they'll use. And then take into account your margins, your unit economics, the quality of the team, the risk profile, whatever, the growth. They will price, the pre-money valuation, which we spoke about before, the valuation of the round, the price, whatever, will be a multiple of this. So let's, for easy terms, these are not my numbers, I'm just giving completely easy ones. Say your LTM was 10 million and you got a nice multiple of 4x, which is quite high actually. But if you're highly profitable, growing, good team, competitive round, that would give you a valuation of 40 million, right? In fact, key caveat, this could happen on a break-even business or even a business that's losing a bit of money. So bear that in mind when I get to the next bit. So I guess what I'm saying is venture valuations, and this as a whole, that's how they'll calculate it, but it will come off a foundation of ultimately buying into a future vision. And venture is a lot riskier than, say, PE, which is where you're more likely to get an exit. So that's the raise side, in my opinion, which is based on other knowledge, etc., like I said. Exit, fundamentally, usually, is going to be a multiple of EBITDA as the foundational number. But then that multiple, and the multiple is the key thing in almost all of these things, will fluctuate massively based on, so you could have a 3x multiple, which would be small. Let's just say your business is doing $1 million EBITDA, for the sake of easy maths, which is good, by the way. If you get to that level, you've got a good business, especially if it's sustainable and growing. Obviously 3x multiple, you sell for 3 million, right? Not 33 million, 3 million, ignore me. Sell for 3 million, just easy maths. That would be a pretty shit multiple on a fast growing brand. Obviously, if you got a fucking 10x multiple, you sell for 10 million. If you got an insane 30x multiple, very rare but doable, you sell for 30 million. Yeah, in theory. But the other factors that, especially on exit, affect the quantum or the actual multiple on your bottom line EBITDA, which is fundamentally what you're going to get judged on, are factors like scale. So if you're a £10 million business, you'll get a lower multiple, generally speaking, than if you're a £100 million business, because £100 million businesses are far rarer and as a result command bigger multiples. It's just how the private markets work. That is why you will hear bigger exits framed as a revenue multiple. Sometimes they are, by the way. You could have a business that's not even profitable that sells for a revenue multiple. But usually the business is profitable, and like take the Wild deal, which again, public domain, I'm not saying anything I shouldn't. It's 230 million, I believe, because it's on Company's House. It was about 70 million in revenue, about 7 million in EBITDA. So if you look at that on an EBITDA multiple, it's what, 33x or something, which is pretty insane. On a revenue multiple, it's 3x, but really it's still being valued on an EBITDA multiple. But you're not going to get that kind of multiple on either top or bottom line if you're small, because there's a lot of small businesses, they're lower risk, they are less established in the category by default, so scale is very important. Category, leadership or even ownership is important. Growth rate, if you're growing fucking 100% a year, you will command a high multiple. Team, I guess, and quality of revenue, and kind of team and quality of the business, rather than just, is it a fad with one founder? Diversification in terms of channels. If you're a D2C only these days, that's considered quite risky. So you want to be like retail, Amazon, D2C, whatever. What else? Yeah, and I guess like kind of the growth story. Like, is there an opportunity to say that it's a UK only business, it gets acquired, can the acquirer go and do it in America? Or have you already done America and that's why you got to the scale and actually you probably command a lower multiple as a result? So yeah, fuck, I sound like I know what I'm talking about, but to be honest, I do just read a lot and speak to a lot of people that tell me this stuff. So maybe I do know quite a lot about this, having still never sold a business for a shitload of money, which I'm working on. But yeah, you get the idea. Basically, you can definitely sell a business on a smaller scale. You know, I've had people selling small brands at 3 million revenue, 300k EBITDA, but you're likely to get a 3x EBITDA and, you know, not even a 1x of revenue, probably, because of all these combination of factors. Generally, the bigger you are on a top line and bottom line perspective will command a bigger multiple, which obviously combined with a bigger number in the first place is where you get to these big exits. So, but it's quite exponential as well. Like, you know, Poppy in America, 500 million revenue, sold for 2 billion thereabouts dollars. So 4x revenue, don't know the profit, but either way, it's going to be big EBITDA multiple if it was 4x revenue. And that's at scale. So, you know, start to get into 4x, 500 mil, that's where you get these crazy exits from. And that's from a strategic acquirer, which I spoke about last time. This was meant to be a short video, fuck. Who buys a brand at, someone asked, who buys a brand at 5 mil rev, 1 million EBITDA? Good question. I mean, it's quite small, but it's a good EBITDA percentage. Probably mid-market PE. You'd speak to someone like a Spain Lindsay, who are a broker that specialise in, this might be a bit small actually for them, I don't know, but PE, maybe there's a secondary deal with a family office, potentially even a deal to be done with the VC, but they would never buy the full thing. Or, you know, kind of private buyer. I have heard of deals being done where like literally like a wealthy individual will buy something like that. But yeah, I'm not an expert on the smaller stuff because people I've spoke to, mostly it's been about where we're trying to go. So I've been speaking about businesses of 50 million plus in revenue. So yeah, there's options. There's definitely options. But again, the multiple will probably be smaller depending on a combination of these factors and others. So yeah, look, final question because I'm rambling on. In fact, not even question, right? Final hypothetical case study. Someone asked, if I had 25k and wanted a £200,000 a year profit lifestyle brand, what would I start and why? Well, probably instinctual response to that would be you don't make 200 grand a year profit from a brand if it's purely a lifestyle thing, because the lifestyle thing implies not working very much and just kind of wanting it to run automated on the side. So I would, based on the way I've interpreted the question, I'd probably say go start an agency or go start a fucking info product. Because I think way better cash flow, much higher margins. Like info runs at 50 to 70%, even higher. I've heard agency, I'm not sure, maybe 30 to 50% in some good cases. Some people might tell me less. D2C is probably, there's obviously a range, but 10 to 30% would be good. 30% being the upper end. So yeah, I'm not sure building a consumer brand, like realistically you're going to get there, especially in terms of money out of the business. If it's going to be quite small, you're only putting 25k in and want it to be a lifestyle brand. But let's roll with it. I feel like I'm giving away all the sauce here. I mean, for simplicity, I would have a one product brand, one SKU. So like one product, one flavor, one product, one version, literally one SKU if you can. I'd be one market. I'd be one channel. Because with that amount of cash, you're going to blow it very quick if you are not laser focused. One channel. Sales wise, that'd be, D2C. And then, I can't even fucking write, one marketing channel, probably Meta. And I would do everything I can to get a proof of concept on your basic unit economics for if it's scalable, i.e. what is your acquisition cost? Because that's the first thing you need to know. If that's not remotely viable, it's never going to scale. So I'd probably pick something that ideally is a combination of what I'm interested in, because then I'll be passionate enough to fucking grind, because it is a grind, and something that actually has a market opportunity. And this is a sweet spot. I think I spoke about this in like my fucking previous videos, maybe on my course, whatever, but like this is like the ikigai zone or whatever it's called, like this Japanese term, which is like a combination of what you can make money from, what you're interested in, what the world wants, or like where you can do good, whatever. I try and find something ideally in this spot. And only you know what that is, right? Only you know what your interest is. Market opportunity, again, you should probably just get to know the market, do your research, trending categories. I think you're going to want to ride something that is a good category. And that saying of like the vehicle you're in is more important than how hard you push or whatever it is, I think is very true, especially when you have limited funds, let's say 25K to start, because you're going to need it to be like, it's going to need to be profitable first purchase and profitable pretty soon. And I think to do that with limited funds in any category, you're going to want to be in a good one. And also when you care about enough to deliver a product and a brand and experience that is good enough to stand out. So that's what I'd say on that. Hopefully that's useful and makes sense. And yeah, fuck, with 50 odd minutes in, depending on how much I cut this, 45 to 50 minutes. I like speaking about this stuff, but I feel like I'm maybe giving away too much stuff. But yeah, hopefully it's useful. I mean, if anyone does want to book a call with me or whatever, I do that on the weekends now and then. I do like a few a month. Honestly, just because so many people ask me, I do enjoy doing it. Yeah, it's not cheap, but I think you get a lot of value out of it if you are looking to raise whatever. I get a lot of people emailing me saying, can we just jump on a call, etc., etc. So that's why I made this stuff. It's like, well, I want to give people a forum to chat to me and share my experiences with, if useful, but I'm obviously not going to do it for free, and I don't have time to be jumping on calls with, jumping on 20 calls every week, giving away everything I know. So that's why I did the YouTube. But if anyone is interested in doing some weekend consulting with me, I do that now and then for the reasons I've just explained. So yeah, hopefully this was useful. I've just spent the last hour of my Saturday evening, early evening. I'm going out soon on a date with my girlfriend. Try and get away from the screen for once. Yeah, I'll dive into anything in more depth. Leave a question below or comment with a question on anything you want to see, anything you think is annoying in these videos, whatever. Is it too long? Is the format good? Is there anything that I'm not covering that you think would be useful? Just in the YouTube in general, not just on this topic, but this topic seems to resonate with people because it's the first time I've gone deeper into something specifically relevant to me that isn't often shared in other forums on YouTube. So yeah, let me know. Hopefully this was useful. Subscribe to the pod as always. More waffle coming soon. More chat in a bit. Bosh.